Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Friday, February 14th, 2025. It is 2:44 p.m. Eastern Time as I'm starting the video, and I'm going to do it in this order. Start out with a brief update on the equity markets. I'm going to do what I like to do from time to time, just walk it down from the longest term time frames that I typically cover, which that's what we're looking at here. It's a monthly chart of QQQ. And I'm going to step all the way down, get pretty granular down to at least the 15-minute, maybe even the 5-minute charts. And then I'll cover a couple updates on some of the commodities that I think stand out right now, or well, trading ops. As far as commodities, yeah, we'll stay individual stocks. I have to cover that in the next video. This is QQQ monthly chart, and so down below you have the histogram. Well, you have the PPO, and as I said, we have rarely seen monthly divergence. But this PPO histogram, if you focus on that, as I scroll forward here, let me get a few clicks up. I've covered this many times in the past. Here, let me park the PPO itself. And we can just, even the RSI, that'll give us a little more real estate to look at on the video. And we'll just look at the PPO. So again, something I've covered many times in the past. You have these red, there's a little red, that's why I zoomed in here, red bar right there. Again, a monthly chart means you have to have the entire month you're down below the PPO line, which I just parked. Those are your PPO, the curvy lines. I don't have a curvy tool here, freehand. When the PPO line crosses down below the signal line, that's what we call bearish crossover. That's the one I just parked. And then the histogram will go red. So the further the histogram's red or green, it just means the higher the PPO line is above when it's green or below when it's red of its signal line. And traders use that. It's a good trend indicator, kind of giving over overview of the overall trend. So what I've done here, again, this is many times in the past over this, showed you all the corrections associated with every single time the PPO has crossed red, both corrections in bear markets going back as far as you can roll back on QQQ. You know, it's an ETF, tracks an index. ETFs came, popularity was back in the 90s is when they started coming on board. QQQ was one of the first. So I'll just read them out, rounding off 20, 20, 30, 85 or 84%, 18, 55%. So these are the last few true bear markets. Since 2008, the Fed and the federal government both initiated or tried to instill a policy of ban all future recessions and bear markets. So, that 2008 one was certainly a nice one, but then this is where the grand experiment started. And that grand experiment is print as much money as you need to keep the economy going, and therefore effectively try to ban the historical and pretty much natural cycle, what we call the business cycle. And that's simply, if you took economics 101 in high school or college, it's simply expansions and contractions in the economy, or economic growth or expansion periods and recessionary periods. So either way, that's what happened there. And so from there, they kept the pedal to the metal and decided, you know what, why don't we just, instead of using interest rate cuts to kind of, shorten the duration and severity of a recession, why don't we just keep zero rates forever? Because we're not seeing inflation anymore. And that's what happens after a 50-plus year bear market in interest rates, which I've covered many times. Interest rates peaking in the early 80s and falling steadily in a secular bear market until this point right here. So the infinite wisdom of the Fed and the federal government, we can just spend money on deficit spending from, fiscal stimulus and monetary stimulus, keep free money rates. That was what gave us a supersized bull market, which started to wobble in recent years. There was a 31% drop right there. But again, the point is, if you look at the red lines, these are the technicals. We can sit here all day long and debate about whether the Fed is going to be omnipotent forever in staving off any major recessions. Obviously, myself and others think this grand experiment is going to end with drastic results sooner or later. And we've already seen the genie come out of the bottle, and that is the fact that, guess what? you print enough money for long enough and keep rates artificially low, suppressed below the natural rate, then you are going to get inflation. So we're going to talk on that a little bit towards the end of the video with some of the trade ideas there. So all I can tell you is the last time we had some nice, clean, a good old-fashioned bear market was in 2021. We had plenty of sell signals to get us short. This PPO histogram crossed over early on, telling us the trend had changed. You look for these big green hills. And again, you do not have to be an expert chart reader to see when it's an impending cross is likely. There's no guarantee. Sometimes you start going down, you bounce a little, things keep going. But again, just look at the slope of the hills, look at where things are going. Eventually you get the crossovers and then the drops, 18%, 55. So take those signals, don't take them, do what you want with them, but they're great long-term 401k indicators and help with the trend. So we can see where things are going. It's just a matter of time. Remember, the signal usually comes after, almost always after the market. Not always, but almost always after the market peaks. And so to me, it's just a matter of time. And you can also see, nothing goes on forever. It's not a hard set limit, but there's typically a limit to what I call these green hills. Those are the periods of expansion and bull market runs. All right, so that's it. We'll see when this crosses. The other things to watch are obviously the primary. This is what I call the secular bull market uptrend line comes off the 2009 lows right there. We've had several tags of it along the way, including most recently there in the last cyclical bear market. These are cyclical bear markets within a secular bull, larger bull. And so at minimum, next one should bring us back down to test that trend line. If you're of the mindset of Powell and Company, the stock market can go up forever and recessions are now banned, then you just keep buying pullbacks too there. Otherwise, if you're more of a realist, it's saying that no trend lasts forever, and the more you juice one, more likely the more powerful the next bear market will be when it comes. Either way, it doesn't matter. When that trend line gets taken out, I will be talking about it, whether it happens in 2025 or 3035. All right, and just watch that trend line there. The other good indicator here is this blue line right here. It does a phenomenal job. Been using it for years in both the S&P 500 and Nasdaq 100 of defining bull and bear trends, and that is on a monthly time frame, a 20-period exponential moving average, aka a 20-month moving average. And it's just if you want to use a simple 401k indicator, you're long and strong there, and you have cash to deploy. Buy pullbacks to it during a bull trend. Keep buying until it's taken out. Once it's taken out, short rallies back to it, or get out of your 401k or stay short the market until it's recovered. And you would have caught virtually all of the best secular bull and bear market, within there. Back here, 2003, bear market was over. It said get long and strong. There's a financial crisis. Doesn't look like much, but that's, again, what was it, 58% or something drop. And then we took it back there. And like I said, since then, and it's a monthly chart. All these little tails, they don't matter. All that matters is a monthly close when you're trading the monthly chart. So you want to see the candlestick close the month. And if you get a whipsaw, none of these were. These are green candles that mean you snap back above there. So the last time we had said get out of your longs and get short in your 401k long-term funds, trend shorts, the kind that you just tuck away until the trend changes, was back here in 2022. And then you recovered it there, and that's it. So those are the bigger picture. I told you I'd start with the bigger picture. Now we'll step down to the weekly. Same story I've been talking about for a long time. This is a busy board. I have board 8 shows some longer term targets right there. T7 still looking for that. I'm back where I was at the end of last year when we were at the same level, about a 50% drop in the Nasdaq 100. We broke this uptrend line right here off the July 5th lows. I think it was August 5th lows. We're below it, and so that's it. That's a breakdown. nothing goes down forever. Sometimes you do break down, you'll go to a deeper target. Sometimes you have a little snapback rally. So that's it. The market is below that primary, very important trend line in my opinion. We're going to step down now to a daily. We are still in this trading range, multi-month trading range. We're pushing the upper limits of it. Again, I had, we had a pop here. I've had this purple line, and I acknowledged this yesterday that we popped above my purple lines. Told you that if we did, I expect it would be limited in scope. It would be a false breakout that will fail, and I'm still going to maintain that is the most likely scenario. And when I get down to the intraday charts, I'll zero in on when the next leg down and when that breakout is likely to fail. We'll look at the trigger points there. Told you also yesterday in the video on both the futures and this ETF here, QQQ, that I figure it's best not to, you can expect a breakout. You can certainly try to get in a failed breakout, that is. Certainly try to get in front of it. But I think the safe bet here is to not short above 534. You can certainly sit tight depending on where you're entered and where your stops are if you're shorting. Or if you're a bull, go long. But wait for a fallback below 534. Wait for this breakout right here to fail. Just like when that one failed, it was lights out. And it didn't stop. All was said and done. Again, nothing goes straight up or down forever. You get this zigzags all the way down here. And that's the bottom of the range. So we're still looking for a much more powerful longer-term sell signal and break below that 500 level. Also a flip on the longer-term trend indicators I started the video with. And then right now, as we get a little more granular here, remember I've had this yellow line here for a while, stating that I could easily see the potential for a new high, but it would be a marginal new and still very much still a divergent high, which is what it is right now. So we're going to close the week. Unless they dump in the final hour of trading, we have 1 hour to go. We're going to close on or around there. And again, within close proximity, when you look at the daily chart, this is it. You're still in this multi-month trading range because you haven't taken out those highs. You're a little bit above that box that I had, the green and the green lines here on the futures and ETF. But you can note these. This is the most current uptrend line, and it's well defined. You have been drawing uptrend lines along the way. And you get the little, these are the zigs and zags. These are, oops, I didn't mean to move that one. I'll leave that there. These are the sell signals. Sometimes, like I said, you break down, you get a little kickback. Sometimes you break down, you don't look back. It all depends on the trend. So this is it right here, this trend line. So let's step it down a little bit shorter. Let's go to, let me go to the futures here. I prefer, especially on the shorter term charts, the futures. One reason for that is you have a lot more reaction points because the futures are trading around the clock, Sunday evening through Friday evening, with only 1 hour shutdown periods each day. So you have a lot more candles or reaction points. So on a 60-minute chart, here, let me actually zoom out to start out with so I keep it in order here. 2 hour candles, 6 months. There's the trading range that we've been in. There's my red line right there. Actually, this is, I think, what I have boxed in on QQQ. So you can see we're still right there. This is an ever so slightly, but still very much divergent high from this point to this point. Remember, that was a divergent high, and we got a heck of a nice drop there. There was your divergence. This divergence has only gotten larger now, indicating the potential for a much larger drop. Typically, not always, but typically, the bigger the divergence, the bigger the drop. Okay. And nice positive divergence as highlighted there. We were long and strong off that divergent low. And now it's time, I think, to stay short if short. That's my plan going into the weekend. And to definitely add when we get the next sell signals, which I'm going to drop down now and get to those shorter term charts. All right, so that was a 120-minute candlestick chart, 6 months. This is 3 months, hourly candles. Same thing. This is that divergence line now. Remember, this was a divergent high, drop. We had a divergent high right here on the 60. Remember, the 60 is my favorite swing trading time frame. I just love the 60-minute charts. Again, I'll use various time frames. I feel strong about incorporating multiple time frames in your trading. But you can see, again, divergent low, rally up to there. Divergent low, this is your divergence lines. You can see them all marked here. And again, this was a combination of 1, 2, and then ultimately 3. The divergence got divergent low 1, divergent low 2, divergent low 3. Each one was good for a swing tradable rally. This is my trading style here. This is what I like to do. And this is one big divergence, but you also have from this point to this point now, the most recent divergence. And you can see it's getting bigger. And there's that beautiful, nice, clean, well-defined uptrend line. Let's step it down a little further now. Let's go down to a 15-minute time frame. Oops. No, that's not it. This is it right here. There it is. A nice, clean, beautiful little 15-minute bearish rising wedge. This is the kind of get you in quicker, get you out quicker time frame for active traders. 15-minute charts, 5-minute charts. That's it. So boom, break of that. Minimum target right here. Well, actually, I'll give you a minimum if you want a little, probably get a little hiccup there, but that's right there, about 22,046. And then down to here, preferred minimum. Again, this, if we get this, here's how it works. The charts are what I call stacks. So let's just say, hypothetically, next week, or whenever it is, it'd have to happen relatively soon or this wedge gets foiled. It could certainly get a little bigger. We can drift up. But if we break down, we come down here to this target zone. You can see these previous reaction highs. Anything much below there, and then we break good support. And then we're back, well back into the trading range. So again, by being stacked, if this breaks down and takes us down, especially much below this, then we're going a lot lower, probably go back down to the bottom of the trading range. However, if you are bullish and you're saying, okay, you know what, I want to in. I want in on this market. It wants new highs. I can feel it. I can taste it. I saw the comments from the last post yesterday, the right side of the chart, barometer, which is kind of a measure, obviously, of when everyone's just given up and, oh, this market's just going to keep going up. It's buy it, buy it. There's no reason it's going to go down. Trump this, Trump that. That's usually a good sign from my experience again. And then when everyone gets bearish and wants to start shorting, that's usually after a correction or a bear market's been underway for a while, and it's time to do the opposite. It's time to cover and get long. Either way, that would be if you are bullish looking to buy a pullback. I just identified two likely, the first two support levels. This one too, the measured target of the wedge would probably take us down somewhere in there. But again, much below this, these reaction highs is going to clearly put us back down into that multi-month trading range that I just showed you a minute ago. And from my experience, breakouts that occur, false breakouts that occur above or below a trading range will usually whip you around pretty quickly down into the other side of the range. In this case, meaning back to the bottom of the range. And then if you want to get even more granular, you can look at the same thing here on a 5-minute chart, and that's what it looks like right there. You can replicate this on QQQ. Again, you might not have as many reactions. So there is your bearish rising wedge pattern with negative divergence. And there's your levels right there. Boom. Hit that. Bounce. Hit that. Somewhere in there I had a zone more on that 15-minute chart. Okay, now let's talk the other things. Just yesterday, here, I'll pull. I'm going to start with wheat only because I had it up already. This is a chart I gave you this morning. So this is my weekly chart of wheat. Been trading wheat for years, and I'm still waiting for it to what I call let loose. It hasn't let loose yet. This is why I love commodities. There's a lot of commodities, but certain ones, natural gas, coffee. We've seen an OJ recently. They're beautiful to trade. If you get the rallies, it can be full throttle up. You can blow away trading the stock market. Everybody, most of the comments on this site always have been are about the stock market. Most of the money here to be made or in trading, in my opinion, are on commodities, individual stocks. But there's stocks, you have earnings to navigate, and you can have this, that, and the other. Commodities and wheat is one that's just trades so well. So this is just to recap wheat, going back to the late 90s on the left of the chart here. This is your long-term bull market uptrend line, and within there you have these bull and bear trends. And this one here. That was, I forget why I measured that, I guess oversold there, 52% rally. But if you note down here, look at the bottom, you have these divergences. So this was a divergent low. I don't have every divergent low labeled with the word DL, but you can see them. That was a divergent low, and that sparked this 381% rally from bottom to top off the divergent low. And as it often does, wheat went parabolic. This is a parabolic uptrend line. And as I've been saying for years, these parabolic uptrends don't end well. So if you can get in them, great. Milk it. You may not get all of it. If you recognize it for what it is, stick with it. Ride that thing hard. Just start raising your stops. It's hard because a lot of times there'll be a couple shakeout moves at the top that most traders won't. It's going to get your stops. But, if you use wide enough stops and just let it run, you can go until you see evidence of reversal. What is that? Well, trendline breaks, bearish engulfing or bearish reversal, topping patterns, things like that. And the drop there, you know what? I don't have the drop measured, but I can tell you it was well over 100% drop. You can do the math here. It's about 1,300 and something, and went down to about 400 or so. So nice, cut down quite a bit. And then again, it just trades well. There's a bullish falling wedge pattern. Let me use my little arrow tool. Bullish falling wedge, divergent low, boom, 110% rally. Back then it was, if these notes I would have used at the time we were trading this. I was trading back then. We had WEAT, which we still have now. Coffee, they got rid of the coffee ETN, I believe Joe. Some other ones out there that we used to trade, but futures traders, you can still trade those things. All right, so 110% rally, and then a beautiful little downtrend line here. Again, highlighted at the time. I would have, these are notes that I did back then. Reversal off long-term support with positive AK bullish divergences, so that we went long back there. And I don't have it measured from high to low, but you can do the math again from about 400, down here, about 400, all the way up to 1,300. That's more than a triple, 300+% rally, just like back here. That's the nature of this beast. And so the trend started getting going. And then at this point here, it hit the trend line again, that same trend line, and it started going parabolic. And then that parabolic advances typically don't end well, and you had a heck of a correction. And so that brings us to where we are today. This is the setup I gave you. I've been highlighting this chart since last year. If we happen to get rejected here off the trend line and pull back, I would love to see it hit this primary secular bull market uptrend line. But sometimes you get close enough and that's it. Either way, as I said this morning, if we break above there, I've given you 1, 2, 3 long-term targets. We've been long since back here. In fact, those charts, I'd like to do the before and afters back in December. I gave you this chart right here. I said a buy signal will come on a break of this downtrend line. That was the post I give you this morning. We were right there. We hadn't broke it yet. We went down. Boom, there was a breakout. And if you missed it, you were lucky. You got a gift. You got a back test. And if you took it, as a swinger trend trader, then you are up. If I can use my measuring tool, you've already made 13%. How much have you made on this stock market that just won't stop going up since the breakout, since wheat broke out? And you made, again, 13% is nothing huge, but let's compare it to the Nasdaq 100 since that same point in time. You made about 7%, if that. And I'm cherry picking the low, by the way, not the point where wheat broke out. From that point, it's less. So again, the stock market's going nowhere. Over time, the stock market will go up. Over time, wheat will go up. Corn. It's hard to imagine 30 years from now those things won't be worth more than today because inflation makes it. But they're great trading vehicles. So. Either way, there's your targets. Let me go back to wheat, and then I'll move on to the next ones. Wheat, again, these are long-term, what I call trend or long-term swing targets right there on wheat. And we are in, remember, this is when COVID hit. This is why we started going parabolic. We're in an inflationary environment. Sure, you can contribute it to the invasion of Ukraine from Russia if you want, because you can say what you want, but the charts price all that stuff in. The fundamentals and technicals go hand in hand. They're there for a reason. It's just, you're rarely going to have a outright bearish looking chart, bearish technicals with super strong fundamentals. Fundamentals over time play out. It's the technicals and the fundamentals marry. In the fundamental, there's often a fundamental catalyst. Certainly that's when we started going parabolic. And again, the war never ended. So why did wheat go down so much? All right, and there it is. It's technical. Said that was it. We had a parabolic uptrend line drop, And again, you're in over time, we will go up. You just have to be more selective. If you're a long-term investor with a 50-year horizon, put your money in S&P 500 index fund or buy a bunch of blue chip dividend paying stocks, because you're going to collect a dividend on top of that, and over time that'll. Grains and commodities, they don't pay dividends, so you need to trade those. You get in when it's bullish, get out when it's bearish. All right, the other ones I wanted to show you, and I've been covering these recently. Let's talk coffee real quick, because that's on the top of my list right now. So let me go to coffee. Oops, where's my? Why is this scrolling this way? Okay, there it is. So, this is one that has already had its most recent parabolic run. Like I said, this is my weekly chart. These are the parabolic moves. Sometimes they're linear trends, just normal, healthy uptrends with clean up trend lines of which to buy pullbacks to, and then which to short when it breaks and game the short trade. But quite often, coffee, for whatever reason, crops, climate conditions, geopolitical events in Africa and the Central America, which tend to be politically unstable places. Who knows? Who cares? I don't care. Cares. This is a parabolic uptrend, and watch, rinse, repeat. These are high double digits. At least usually these drops that follow are usually at least 50% drops, sometimes more. And I covered this as recent as yesterday. And when you go parabolic, it's not unusual. Oh, did not mean to do that. It's not unusual to see divergences like you did here get slightly taken out on that last kind of gasp of air right there on the last, near vertical launch. So then what you need to do is drill down to daily and shorter term charts. This is a 60-minute chart. So this is, and you can get, this is on vesting.com. They give you free futures charts. I have multiple platforms I'm using, but I had a dual uptrend lines. This was the primary uptrend line right there. And this is what if you followed me for any period of time, you've heard me, I use a term I call BOD, or benefit of the doubt, because I could come in and catch a few spike lows through there. And I had a price alert, boy, triggered today, and in one fell swoop. In fact, I just covered coffee with you yesterday, and I give you the same uptrend line there. This is KC Coffee Futures. So that was it. So boom, we broke down, and that is a sell signal. So that we hit that first target right there, 409. Coffee bounced. It stops trading. If you trade futures, you should already know this, but if you don't, the quirky hours, it starts trading in the middle of the night. It stops, I think it's 1:30 p.m. Eastern time when it stops trading. But so basically that's it. There's a sell signal. Next one comes on a break under 409. Should take us down here, and then take us down here. And again, the trend is once that parabolic trend, and this is why I do these videos. I know they're long-winded sometimes, but I can convey my thoughts. So when I am shorting something that has broken a parabolic trend, I am much, much less likely to cover and try to game the early bounces off support for the reasons I've talked about. Those things don't end well. It's usually full throttle up and then full throttle down. So I use this breakdown today to add. I already had a position, and I added to it. And on the bounce, I waited for the bounce to happen, added before it closed, and I will add again on the next breakdown. I don't care to game early bounces there. And I still have what I call a starter position with plenty of room to add to this one. So that's what it looks like. The March contract, I'm actually in the Mays. Let me show you that one real quick. This is the May. This is my 6-month chart. I've got multiple, as I've showed you a lot of different, there's the breakdown today, and hit that first support. And this is just that measured target, but that thing, coffee usually falls about 50% when it goes parabolic. So there's where I'm swinging it down to about 237 right there ultimately. But these are where obviously these are support levels. Any or all of these could produce a bounce. Any or all of those, when taken out, will open the leg, then door down to the next leg down. All right. Okay, so that's that. And that was that uptrend line I already showed you. You can step it down. There's more volume in the maze, even though the marches are still trading. There it is on the 3-month chart. So that was it. Boom, 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 boom. Okay. Here's another one. This is the environment we're in. A lot of these ag commodities, it's the inflationary environment we're in. That's where I kind of started the video going back to that. That's what's going to ultimately be the, kind of the death blow to the market and really castrate the Fed, if you will. We've already seen it. The Fed's lost control. I've heard some of the media recognize that, but it should be a much, much bigger, important headline that 3 rate cuts in a row, and each and every time they did it, long-term rates, the rates that matter to the economy, did nothing but go up. And I don't know if that's a complete historical first to see 3 in a row like that and a whole rate hike cutting campaign, which is now effectively over. And we saw the opposite of what's happened historically. And either way, but this is it. Orange juice futures, same thing, just like coffee, just like cocoa, went parabolic. And you can see what happens. Again, it's not parabolic here. I've got a log scale on this chart, but it is certainly a move up from about, orange juice has been trading for years, about $100 right there, all the way up to 500 and change. And then boom, you broke the trend line 1 and then the BOD, or the more significant uptrend line. And it's just nothing but red sticks. Look at that. Boom, boom, boom. And sooner or later, you're going to get a oversold bounce. Look how oversold it is on the RSI. And we parked right at, and these are the same targets I've been sharing with you. Parked today at 321.68 or so, or hit that and had a nice bounce off it. But again, this is what we'll probably see soon, and maybe starting today. We'll see if that breakdown on that 60-minute chart on coffee sticks. And that's so far from the highs to the low. And this is since just end of December 20th. That's a 40% drop. So you make 40%, or any part of 40% in a matter of a couple months, and you're blowing away trading the stock market, because since middle of December, the stock market's gone absolutely nowhere. It's gone up and down, still trading where it was. Let me wrap up by just looping back to something related to the market. And I'll talk to Mr. VIX. I told you the VIX was looking good recently, and nothing in my view has changed in my outlook. Same with the stock market. Like I said, you're going to need to see the breakout fail. We could certainly go up a little more, keep the divergences building on the indexes. This is the VIX. This is a 60-minute chart. I've been covering this for months now, along with these corrections in the stock market. Look for, just like the stock market, but it's in reverse. You look for divergent lows when you think the market's going to drop, or you look for divergent highs. Usually, you do sometimes get divergent highs in the VIX, but quite often, to trade the VIX, you want to trade the stock market, particularly ES, the S&P 500, because that's what the VIX tracks. There is a VIX for the Nasdaq, but it's not as liquid. The futures aren't. So I like to trade, the regular VIX, which tracks the S&P 500. But again, the Nasdaq drops 10%, the S&P is going down too, and the VIX is going to surge. That's it. Divergent low, divergent low. We were in on that one right off the lows with impunity. That was a 372% move. Remember, you cannot trade the VIX itself. You can only trade options on those on the VIX. Futures on the VIX, options on those futures contracts, or one of the various ETNs or ETFs that track the VIX, which they in turn use the futures to do so. So divergent low, 61%. Divergent low, 55% rally. And this is the trading range. Does this look familiar, this purple box? It's the stock market upside down, and it's QQQ upside down, what I've showed you. Remember how QQQ recently had a false breakout? But look what's happened now. The VIX didn't break down today. Interesting. The QQQ broke out above where my red line is, or green line there. Remember, this is in reverse. All I can tell you, again, just like I can tell you that we're still in the trading range, We're still below the previous all-time highs, but just above that line I had, which is a couple of the recent reaction highs. I can tell you had a divergent low there that was followed by a 90% rip. So the VIX, it's an EKG, it's an irregular EKG, but it's just very profitable if you could trade these. So again, how to trade it? Well, wait for the breakdown of that 15-minute chart I just showed you, the 15-minute uptrend line. And that would most likely be the catalyst. In fact, you could probably add a comparable little trend line right there. And if it pops, remember, we have big divergence that's been building. This is positive, aka bullish divergence. The line's been going right here. We had a divergent low here. We popped. That was, I don't know, 80%, 70. I don't know if you can measure it. And we're still here. Now, if the stock market's going to go to new highs and beyond, anything more than a marginal new high, yeah, the VIX is going to go down. But I think the downside's limited. I've been saying that for a while now. I also say you have to be your timing has to be very good with the VIX. It's not something you sit and wait and hold when it's at support. Because if you could buy just the VIX, yeah, great. Why? Because you look at it from a long-term chart. I just toggled to a weekly chart. You're at the floor. And if you could buy just the regular VIX, the spot VIX, which we're looking at here, and you buy it at this range, well, if you had to wait a few months, even a year or more, you're going to get paid, right? However, you can't buy the VIX, as I said. You can buy futures, options on those futures, or one of the many VIX tracking ETNs or ETFs. You pick your poison. But I can tell you definitively, you are guaranteed to lose money if you buy and hold these things. This is VIXY. Doesn't use leverage like a lot of them. It's short-term futures, so it's one of the least volatile of them all. But if you bought it back here in 2011, when shortly after it came out, you would have lost all your money, 100%. You can see my pop-up box to the left. And if you're wondering why that is, that's their expenses. They're rolling. They can't put and hold the spot VIX. They have to roll futures that are expiring. There's expenses, fees. So it's a great hit and run vehicle. I've given you many trade ideas on this in recent months. Right there. Again, I've removed the it had a reverse split, so my target's left. We went long right there, caught the bulk of that run. We were long here again. I've highlighted in pre-market that I had the 57.28 target was hit right there. So with impunity, we got in there. With impunity, we got in that one. And I'm just waiting for this next one. And here's the downtrend line. And so looks like it's ready to pop. And so let's see what happens next week and next week or two. No sell signals in the stock market. The VIX isn't going to go anywhere. However, it's set up with this positive, aka bullish divergence, just like we had there. And we got a nice pop, just like we had there. Another pop. The divergence gets bigger, just like the divergence keeps getting bigger in the stock market. So when this thing finally goes, if it breaks out, wouldn't surprise me to see us go above here and see this little area right here, this 57.28 target. That was my target from the last trade. That is comparable to the red line I have on QQQ, the recent trading range. Let me just show it to you this way so you can see how I see things. This is the trading range right here on the VIX recently. Keep getting this level. And when we flip the stock market upside down, there's QQQ. And there's the trading range here. Right there. So, and it's a big if, but this is why I do these videos, react, and we never get the sell signals, or we break down and then it's a whipsaw and this market rips up to new highs. I can't rule out a blow off top. But if we do this, and then we go on to break my red level here, we'll go back to TVIX. And again, you can use TVIX for charting if you're short term. The decay happens over a period of time. Oh, VIXY, I'm sorry, VIXY. Then there's that comparable level. So it's very, very reasonable to say that if we just go back and test the bottom, let's just say we go back down, QQQ does fail to break out. We go back down to my red line, that red key support level, the bottom of the trading range, but then we hold, and then we go to new highs from there in the stock market. Even if that happens and the market goes to new highs, you're going to get, this thing is going to rally up here, probably go to the top of that level again, give or take. That's 50% right there if it happens. And The nature of the VIX and the nature of corrections is they happen very quick. You know, if you wait for Kramer to tell you to sell your stocks in a bear market or you know, buy the VIX or whatever, it's too late. You've missed the move. So you got to get in front of these, or you got to act quick when you get the sell signals. And then again, longer term, you start going to longer term charts. That's what I've given you. Over time, I'll modify these. This is the VIXY on a daily chart. There's that beautiful big bullish falling wedge. S2, S1 is the trend line for support. This is a swing. These are swing targets. There's that same trading range I just showed you there on QQQ and VXY. And so if the red support level on QQQ goes, we'll probably take out, almost certainly, almost guaranteed, we'll probably take out T1 before that even goes. The VIX will start spiking up big if we head down back to the bottom of the trading range anytime soon. And then these are potential targets. So for a swing target, again, this will entail for T3 to be hit. That's 170% rally in VIXY. We're going to have to see QQQ and SPY ES break those red support lines, i.e. the bottom of the trading ranges I gave you. Okay, so that's it. So there's a couple trade ideas for your analysis on the market. Trade the VIX if you want the juice. Otherwise, if you don't know what you're doing, stay away from VIX instruments, volatility, VIX, any VIX ETNs, ETS futures. Certainly stay away from options if you're new to this game. Options are a quick path to ruin if you don't know what you're doing. They give you more leverage and you need to hang yourself. And then you have that time element. So stick with shares, to begin with. And if even if you're brand new to this, you don't know how to even short a stock, you can buy inverse ETFs. SH shorts the S&P 500 with no leverage. PSQ shorts the Nasdaq 100 right here. And this is a daily chart. This is what it looks like. It's just the stock market or the Nasdaq 100 in reverse. You have a positive, aka bullish divergence. You have a nice clean downtrend line right here. And that's a big bullish falling wedge pattern. And so we break that, boom, we're going to go up, hit the 200-day moving averages, which would correlate with QQQ pulling back to its 200 days. As I often say, traders love to buy in a bull trend. You buy the pullbacks to the 200-day moving averages on QQQ and tech stocks and the S&P 500. And this is just QQQ in reverse. And that's when they were taken out, meaning they broke out. The QQQ broke out above the 200-day moving averages. And then it said, hey, guess what? We're in a new uptrend in QQQ. And then you buy QQQ. But again, this is a short ETF. So this is going to be the market in reverse. And so, boom, Papa there is going to take you for another test of the 200s. And then ultimately at some point, and I believe it'll happen in early 2025, we're going to break the 200-day moving averages on QQQ. And then we're going to go up and hit some of those longer-term targets I gave you. So this one, what's nice about these, I wrote up about this years ago, the pros and cons about using leveraged ETFs in your trading. And so I recommend read up on that if you're not familiar with it. It's on the FAQ page on the right side of the chart under ETF-related questions. And I highly recommend to read that if you're not familiar with what leverage can do to you. And leverage cuts both ways. So catch a right trend, what I call... Oh, I hit some button that did something. Don't know where I missed it. But this is a leverage ETF, TQQQQ. And as I covered in that explanation about leverage ETFs, if you get a right trend, what I call a unidirectional trend, where you're going almost most of the candles in a downtrend are red, straight down or straight up, you'll actually outperform using a leverage ETF. But those are pretty rare. It's like trading the VIX. You got to be Johnny on the spot with your timing. And if you get into a trend with a lot of back and forth or sideways grind, this is where the decay is the worst. Sideways trading ranges, you go up, down, a lot of red and green closes to go nowhere. Even if the underlying instrument, in this case QQQ, is flat, you're going to lose money in these guys. But if you can get these trends then you do outperform. So, and I try to do my best in any trade that we're looking at, let you know not only where I think it's going, i.e. price targets, and then buy points, entry points, or sell points, but also how it's going to get there. Like I spent the beginning of this video telling you where when coffee finally corrects and this uptrend is over, it's not going to be a nilly-willy, or grandma's downtrend. It's going to be hard down, most likely, due to the historical nature of how coffee has traded following other parabolic uptrends. Okie dokie, I'm going to wrap up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.